As particular to Chinese investors in China, I think one thing I would especially think would be really important is really understanding the idea of quality businesses. When Warren Buffett, especially in the later years, focused on investing in companies, he really focused on investing in companies that weren't just successful in the next year or two. If you take an example like American Express, if you bought it in 1964 and you watched how it developed in the next, not just 5 years, but 10 years, 20 years, 30 years, 40 years, you're really looking for businesses that have a very stable and certain kind of structural growth and prospects to be able to be successful with some certainty level over a longer time frame. And I think that's a concept that once you learn more and more about how to invest properly, is often undervalued by the market, and I think that's also something specifically that maybe for Chinese investors is also very important to understand.
Great. Tom, let me ask you, what sector stocks are most appealing to you right now, and do you think those ideas match Buffett's ideas?
Well, they derive from Buffett's ideas. I think if you were in my class in 1982, Warren would have been excited about See's chocolate. He had owned it for a period of time, but it was a new position. And it was the position that took Berkshire away from the old 50-cent dollar bill approach to value investing, where you buy assets on balance sheets at a discount, close the gap, and move on. Well, it's very taxable, and it doesn't have any pricing power or anything uniquely beneficial that can be enduring. Along came See's chocolate for $35 million, and Warren bought it, and subsequent to this date, it's generated $2 billion. And it's reported by Warren himself that it's the one job that he does personally in Berkshire Hathaway, which is price See's chocolate, hopefully high enough that people feel that when they get a gift of their See's chocolate, that somebody cared for them deeply. So price is part of the product, and that's a lesson that came from See's chocolate. The other lesson from See's chocolate was that you have to have the capacity to suffer. Warren would tell you that the reason why See's works is they have a pure chocolate-only, candy-only approach, and all of their competitors over the years who had a very similar business hired consultants to try to explain to them what could they do during the 9 months of the year when nobody bought any chocolate whatsoever. And most people said, in the summer sell ice cream, in the winter sell soup, and every one of them lost their way, because what consumers want is a dedicated temple to chocolate, where if you go in there, you have to pay way more money than you thought possible. And when you come home, the gift is secure and its impact. Right. And that capacity to suffer is, those 9 months when you have no business, is all made up for the 3 months where you charge so much that you can have profits. And watching that brand deliver on its promise of price inelastic demand is really powerful.
Right. John, it's interesting what Tom just said, because we think of Warren Buffett's investing as extremely constant. But in a way, it has changed. I mean, you were talking about the cigar butts,
yes,
and then moving to what would be branded growth or brand name companies. And now again, with these are his two investors, where we're seeing Apple, and now yesterday, Amazon even. So how much does the model change, and how much does it stay consistent, do you think?
Obviously the Amazon investment was made by one of his lieutenants. I think it shows maybe what the future of the investment portfolio looks like. I mean, I would really say two things with that. One, I would be very wary on the Amazon investment. I think there's significant antitrust issues that people really don't appreciate. And two, more germane, is the fact that the equity portfolio, while it makes all the headlines when the 13F comes out, et cetera, it's just such a small part of the business that it just really doesn't really move the needle at this point. And one of the things I think that's interesting is Buffett is forced, obviously because of his size, to invest in very, very large companies. So his investable universe is very small. What the average investor can take, and one of the things that we look at, are stocks outside of the major indices, orphan stocks, stocks that no one cares about, because that's where you get the great value. And that's where Buffett had his fantastic returns in the 70s and 80s, when he had the advantage of not, it's a good and a bad thing, of not having hundreds of billions of dollars. I'd much rather have hundreds of billions of dollars. It certainly puts you in a better position, but your returns certainly do suffer.
Right, and you had some investing ideas along those lines, right?
Well, orphan equities, stocks that are outside of the major indices, stocks with family-controlled companies because they can't go into the major indices. There are a lot of different things that stocks that are hated by Wall Street analysts. You just want to be a contrarian. You want to go where everyone else is kind of running away from.